Alright, mate, here's something almost every investor who's actually made real money will tell you if you ask them straight up. The first 100 grand, that's the hardest money you will ever make. Not the most money, not the most exciting money, just the hardest. And here's the thing, almost nobody making that climb right now actually understands why it's so brutal or how long it's genuinely gonna take them. So today, we're breaking that down properly, where most Aussie investors actually sit on the road from 0 to 100,000. Why this exact phase wrecks more people than literally any other stage of investing, and this is the good bit, the handful of moves that can cut years off the slowest, most soul-crushing part of the whole journey. So whether you've got 2 grand sitting in a brokerage account right now, or you're starting from absolute zero, by the end of this, you'll know exactly where you sit on this curve and what actually speeds it up. Now, I've pulled all this together using ASX investor data, Vanguard's long-term return research, and Investment Trends annual reports on Aussie retail investors. So this isn't vibes, mate. This is what the actual numbers say about how this phase plays out for real people like you and me. So let's start with the part nobody warns you about. The first 20 to 30 grand, that's almost entirely you. Not the market, not compounding, not some clever ETF doing the heavy lifting for you. At this stage, basically every dollar in that portfolio is there because you physically put it there from your own paycheck. And according to Vanguard's modeling, on a typical balanced portfolio earning, say, 7 to 8% a year, your investment returns at this point are contributing almost nothing in dollar terms. Think about it. 8% of 5 grand is 400 bucks. 8% of 90 grand, that's over 7 grand. Same return, wildly different impact. And that gap right there is the entire reason this phase feels like pushing a boulder uphill. Now, the average Aussie investor under 30 holds somewhere around 8 to 15 grand in listed investments outside the home and super. But, and here's the catch, it's always the catch with averages. That number gets dragged up hard by a small group who started early, earn well above average, or had a bit of a head start from family. The more honest number, the median, for investors in their 20s, sits a lot closer to 3 to 5 grand. Which means if you've got a few $1,000 sitting in shares or ETFs right now, you're not behind, mate. You're sitting almost exactly where most people your age actually are, no matter what your feed is trying to tell you. And look, there's a real gap worth naming here too. Women in their 20s and 30s, on average, hold noticeably smaller investment balances than blokes the same age. And it's not because they're worse investors. It's the gender pay gap compounding over time. It's career interruptions hitting earlier than expected, and women, statistically, being less likely to have been encouraged early on to even start investing. Smaller pay packet, smaller surplus, smaller starting contributions. And that gap just sits there, quietly compounding in the wrong direction, unless something interrupts it. Now here's where it actually gets uncomfortable, because this next bit, this is the stretch that breaks the most people. The climb from 30 grand to 70 grand. This is the dead zone. You're past the stage where it's exciting to check your portfolio every week, but you're nowhere near the stage where compounding's doing anything dramatic for you yet either. And based on Investment Trends data, this is statistically where investors are most likely to do one of 3 things. Stop contributing altogether, panic sell during a downturn, or get talked into some high-risk punt because the slow and steady approach feels like it's not working. The average time Aussies in their late 20s to mid-30s spend stuck somewhere in this range is often 3 to 5 years, depending how aggressively they're contributing. And the median story? Rougher again, because a fair chunk of people in this bracket aren't even moving through it, they're stalling, going backwards in weak years, contributing inconsistently because, well, life happens. Rent goes up, the car dies, a relationship ends. And this, right here, is exactly where the gender investment gap actually widens instead of closing, because this is the phase where career breaks, parental leave, and part-time work tend to hit hardest. And a pause in contributions during the dead zone costs you so much more than the same pause later would, simply because there's less compounding momentum yet to carry you through it. Which brings us to the big one, the run from 70 grand up to 100. This is the part everyone fixates on, the number that gets treated like some kind of finish line. But here's the myth I want to bust right now. Hitting 100K does not mean you've made it, and the data backs that up hard. Once you're sitting on 100,000 at an average 8% return, The market alone is generating roughly 8 grand a year in growth, which, for most people, is more than an entire year of their own contributions. That's the real significance of this number. It's not a finish line. It's the point where the machine finally starts pulling more weight than you are. Before this, you were doing almost all the work. After this, the work finally starts splitting more evenly between you and your money. Now look, plenty of finance content loves throwing around projections. 20, 30 years out, talking about the 7-figure portfolios early starters end up with by retirement. And sure, that's true, and it's nice knowing that's out there somewhere in the distance. But if you're sitting on 12 grand right now, wondering why it feels like nothing's happening, a projection for 2055 isn't going to help you get through next Tuesday, mate. What actually matters is the next 18 to 36 months, because that's the stretch that decides whether you push through the dead zone or quietly give up, like a huge number of investors do. So let's talk about what actually speeds this up, because this is the bit that makes the real difference. First, automate your contributions so they leave your account the day you get paid, before you've got the chance to talk yourself out of it. Investment trends data shows automated investors contribute more reliably than manual ones, often by a significant margin over a year. Second, even a pretty modest increase matters more right now than it ever will again. An extra $100 a month, invested from 20 grand at 8% growth, adds up to tens of thousands of dollars extra down the track, simply because that money has more years left to compound while your balance is still small. Third, resist the urge to chase bigger returns through riskier bets during this phase. Vanguard's own research shows, again and again, that investors who switch strategies during downturns lock in losses that take years to claw back. Exactly the years you don't have spare in the dead zone. And fourth, if you're eligible, look at concessional contribution strategies or low-cost diversified ETFs that keep fees down. Because fees that look tiny on a small balance, 1% versus 0.1%, compound into a genuinely brutal difference once you're sitting on 6 figures. So here's where that leaves us, mate. Most investors spend their first 20 to 30 grand doing almost all the heavy lifting themselves, with barely any help from the market. The stretch from 30 to 70 grand is the real dead zone, where most people either stall out or quietly quit. And $100,000 isn't some magic finish line. It's simply the point where your money finally starts working as hard as you do. But none of that means you need some genius strategy or a lucky break to get through it. It just means showing up consistently through that boring, invisible middle stretch, because that's the only part of this journey that actually separates the people who make it to 100K from the people who give up at 40 grand, convinced it's not working. If this gave you a clearer read on exactly where you stand right now, hit subscribe, Aussie Wealth, turn on those notifications, and I'll see you in the next one.